Have you ever wondered why some strategy feels safer when they got amount of same cumulative P&L? In this video, I'm going to share with you what is Sharpe ratio and how Sharpe ratio matters in your investment matrices. Sharpe ratio is one of the most popular matrices that is used by investors and quant traders. This is mathematically, the Sharpe ratio is calculated as Sharpe ratios is equal to average return minus risk-free rate or divided by the standard deviation of the return. So in practice, normally we will just ignore the risk-free rate. The formula can be simplified into Sharpe ratio is equal to average returns divided by the volatility. The average return means that the expected mean of your P&L that you have backtested divided by the standard deviation. Volatility means standard deviation of your P&L. From this context, we can know that in order to increase the Sharpe ratio, they got two methods. The first method is to increase the P&L or the average returns of your portfolio, and the second is lower down the standard deviation or volatility of your P&L from your portfolio. To have a clearer look on what is Sharpe ratio, and I prepared two examples. So in this case, I have two strategies, which is strategy A and strategy B. Strategy A is much more smoother compared to strategy B, and then here is strategy B. You can see that they got a lot of much more volatile. They got a draw now and then the P&L, boom, and draw now, boom again, draw now, boom again, draw now, and it's like a roller coaster like this. So as an investor, you will choose strategy A to invest or strategy B to invest, although they have the same amount of cumulative P&L. Of course, we will choose strategy A because strategy A is much more smoother. I can say smoother compared to strategy B is like roller coaster. So it's much more safer to invest in strategy A. Why we term it safer is because they have lower volatility. So this is why Sharpe ratio matters. Sharpe ratio consider the volatility inside your average returns, actually quantifying the risk you put into the investment and the result we will get from your investment. So the larger the risk, the larger for the volatility of your portfolio, the lower the Sharpe ratio. To have a clearer look on how actually it works, I actually prepare some different kind of Sharpe ratio. As you can see here, we got Sharpe ratio of 0.5, Sharpe ratio of 1.5 and Sharpe ratio of 5. So 0.5 you can see is smart, is good, and then you can achieve like same equity value as the rest compare. But the process to achieve that, you can see is much more volatile compared to Sharpe ratio of 1.5, which is not that volatile, and 5 is like really straight line. You can see there's not like large drawn out in returns. This is why Sharpe ratio matters. Sharpe ratio is not just quantifying the average return you get. This is not like just looking at your final cumulative P&L. It's actually penalize the standard deviation of the volatility of the P&L. If your strategy has higher volatility, means that it will have a lower Sharpe ratio. It means not favor normal investor will look on. What makes a good Sharpe ratio? S&P 500 has an average Sharpe ratio of 0.5. It means that for one risk you take, it will exchange in 0.5 of return. I cannot say it's really hard. Warren Buffett portfolios have a historical average Sharpe ratios of 0.8. It's not that high. So the higher the Sharpe ratio, the better the risk-adjusted return. But based on my opinion, a risk-adjusted return or Sharpe ratio must have a minimum of 1. Whenever you take 1 unit of risk, you will get 1 unit of returns. This is why I think that Sharpe ratio has the minimum requirement of 1 instead of 0.5. For information, let's talk about BTC or cryptocurrency. So what do you think the Sharpe ratio is? Actually, I backtested Sharpe ratio of BTC or cryptocurrency is ranging around 0.7 to 1.3. It's actually quite good, especially in this bull run. They got average returns of Sharpe ratio of 1.5, which is like really good. Cryptocurrency is very volatile, it's very high risk. If you want to invest in cryptocurrency, you must take notes on it, although it's actually generate a good Sharpe ratio. If you want to learn more about more performance metrics such as Sortino ratio, max drawdown, or what other metrics that Quant Trader looks in, you can just comment down below. Let me know what is the performance metrics you want to see, and thanks for watching for this video.